So let me paint this picture for you. So you're on the internet, you're probably searching through article after article, trying to justify why you should keep your losing trade going. And really, you probably should have cut your losses $1,000 ago. So instead of being down $100, you're down $1,000 and you probably feel like it's the end of the world. Well, let me reassure you, I've been guilty of it. I'm sure anybody who has traded has been guilty of it. But in this video, I'm going to give you some tips on how to overcome it and how to start making real money in the stock market. Hi guys, and welcome back to my channel. If you guys are new here, my name is Mel, and this is a channel where we're pretty much talking about everything that revolves around making money. So making your money work for you through investing and through trading. If that's something that you think that may interest you, go ahead and hit the like button, subscribe, go ahead and share my channel with a friend or a family member, right? So, and in this video, we're going to be discussing something that is so crucial and critical to your trades. Something that a lot of traders, if they don't currently suffer from, they have suffered from in the past. And if any of the things that I described in the beginning of the video describes you, you may be suffering from it. And that thing is confirmation bias. So what is confirmation bias? I'm glad you asked. So by definition, it's the tendency to favor information and have pre-existing beliefs while ignoring all contradictory evidence, right? So you may be wondering, so why is that bad for me? And what does that have to do with the stock market? And it has a lot to do with it. So when you go into a trade and you ignore all contradictory evidence surrounding the trade that you put on, you may be researching articles trying to find ways to justify your trade. And why this is bad is because when you do things like this, you're going to more than likely do three things, right? So you're going to set larger position sizes. So for example, if you were originally only supposed to buy 10 shares of a stock, you may buy 20 because in your mind, you're thinking, oh, there's no way that this trade is going to go against me. It's always going to work. And then when you do this, you're going to have a bigger drawdown because you put on more risk. So one, you're going to probably increase your position size. The second thing you're going to do is once that position size goes against you, and this is what the confirmation bias tends to kick in. Once that position starts to go against you, you're going to get on the internet, you're going to be in Reddit posts trying to find evidence as to why you shouldn't sell. So now you're not going to be willing to cut your loss, right? So you're got a larger position size, one. Two, you're not willing to cut your loss. And then the third thing I think that is so important is you miss out on opportunities in the stock market that really are like solid opportunities to grow your money. So you're not making sound decisions, right? So I'm gonna give you a personal story, and I've been guilty of it myself. So I remember back in, it was like 2023, 2024. If you've been in the stock market for a while, you know. So PayPal, oh my God, PayPal, I was so sure that PayPal would just go to the moon after it went from around like $230 during COVID, and it fell all the way down to around $65. So if you looked at the fundamentals on PayPal, it was trading at a nice PE ratio. I think it was at like 15 or 16, which in my mind was like, oh, PayPal is getting cheap. And then when I'm looking at the technicals, I'm like, okay, I think we're ready to break out. So I went into this trade saying to myself, okay, I'm only going to buy a couple of options. I think I went in saying I'm only going to buy 2 options. Well, PayPal was around $65 when I did this. And then instead of me selling, when it kept going down, I doubled down. Baby, I bought more. And then I was looking at everything that the CEO put out about how PayPal was going to change the world. If you were a PayPal investor or are a PayPal investor, you feel me. You know me better than anybody knows me right now. I kept doubling down. So it got to the point where I'm not even lying. I probably stayed in this trade for probably 6 to 7 months, and it was nowhere. I was negative, as a matter of fact. And if you look at a PayPal chart today, it's even lower. It's probably around like $45 today. So I did cut my losses. I took my L, but I lost way more than I was supposed to. And you know why? Confirmation bias. Confirmation bias, instead of me saying, okay, I'm going to actually just buy those 2 shares and 2 options. And if they go against me, I take my loss. I kept doubling down because I was just so sure of it. of it. So don't be me. Don't be me in the PayPal situation. All right, so these are the 3 rules that I follow now to avoid a situation like I just described when it came to PayPal. So the first thing I do is when I go into a trade, I always assume that the trade is going to be a losing trade. And I think I heard this from Paul Tudor Jones, who is a really popular trader. So if I do this, if I go into every trade assuming that I'm going to lose, I'm going to be less likely to increase my position size, because going into it, I'm going to say, okay, well, I'm going to hit the enter button or the trade button and I'm going to initiate this trade, but it's not going to work out. If I trick my mind into already thinking that this trade is going to be a loser from the jump, I'm less likely to keep adding to the position, especially if it goes against me. The second thing I do is I only trade 1 or 2% of my account per trade, right? So I typically only do about 3 trades, have 3 open trades at a time. So usually my max open percentage wise of risk, the max that I'm risking on each trade or each on my total account is about 3%. So this is why. If you're able to only risk 1% of your total account, you're less likely to search for reasons to justify why the trade is a good trade to stay in. So for example, if you have a $10,000 account, 1% of 10,000 is $100. You'll probably be able to stomach a 1% loss in this case, which is $100 versus maybe a 3 or 4% loss. And that's just only on one trade. So imagine you wake up in the morning, the stock is going against you. And if you put on 3% risk, so you're down $300. Now you're trying to probe the internet because you're not really comfortable losing that much money in the first place. So you're trying to find reasons why you shouldn't get out of the trade and thinking, oh, well, this trade is going to go back in the right direction. Well, what if it doesn't? What if it just keeps dropping? Versus if you wake up in the morning, news came out, wars enacted, and now all of a sudden the market gaps down and you're only down $100 now. Well, you can stomach that a little bit better. If you were okay with losing the $100 in the first place, you can go ahead and cut your losses and you get out of the trade. Okay. And then the third thing is I actively seek out information now before I even enter the trade as to why this trade is probably going to go against me or why it isn't a good trade. So, and the 2 reasons is why. So for example, I'm gonna give you 2 examples, I should say. An example is if I'm getting into a trade trying to go long, meaning that I'm getting in the trade with the expectation that the stock is going to go up, I'm going to look for things like, okay, is it below the 200-day moving average? If it's below the 200-day moving average, that's the reason why I probably should mitigate my risk. Because usually, if you're new to the stock market, just know that usually if a stock pulls below its 200-day moving average, that's usually not a good thing. It's a bearish thing that the market the stock may continue to go in the downward direction versus going up. So that's one thing. And then in like PayPal's situation, there was so much contradictory news coming out about PayPal. Apple Pay, for example, was the whole argument around PayPal that it was disrupting the use of PayPal, and people were, going up to doing tap pay and they weren't using PayPal because they could just, double click the side of their phone and pay with Apple Pay versus using PayPal. So yeah, actively seek out contradictory information when it comes to confirmation bias. That kind of helps me mitigate it. So number 1, always assume that the trade is going to go against you. Number 2, only trade 1 to 2% of your account per trade. I only usually do 1% per trade, and I do 3% max for the whole position size. So I may have 3 positions open at a time. And then actively seek out contradictory information. That way you are less likely to put on more risk. All right, so what I want to do is I want to give you a little challenge. I want to give you a challenge on your next trade if you suffer from confirmation bias. So 1, the first thing, only risk 1% of your account. Okay, don't open up more than 1 trade. Only trade 1 thing. Pick a stock, trade 1 thing, and only trade 1% of that. So if you have a $10,000 account, you're only going to do $100. If you have a $5,000 account, you're only going to do $50. You get it, right? So, and then define where you're going to get in the trade and where you're going to get out of the trade before you even put on the trade. So know where you're going to do it. Have a predetermined spot where you're going to take profit and where you're going to put your stop loss. And then find one reason why the trade will go against you before you even enter. So like in my case, how I mentioned with PayPal, they were losing market share. So that was something that I completely ignored and I just kept doubling down. So before you go into the trade, find one thing about this stock that says that you're probably going to lose and why you maybe shouldn't take the trade and why it may go against you. And then see how your psychology is after. I tell everybody when it comes to trading, I can teach you how to read charts. I can teach you supply and demand. I can teach you about moving averages. But to me, 80% of trading and being successful in trading is up here. It's psychology. So do those things, see how it goes, and if it continues to go good, continue to do it, and maybe from there, that's when you start adding on the second trade and the third trade, but using the same principle from just trading one thing. All right, guys, that's really all I have for you today. This was a much needed video, I think, for trading, because I have suffered tremendously in the past from confirmation bias. I occasionally still do it and I have to stop myself. And the challenge that I just gave you guys is one way I do stop myself when I feel like I am going over into a situation where I'm starting to have some confirmation bias. Go ahead and like, subscribe, please share my content, help me grow my channel, and thank you guys for watching.